And thank you, everybody, for joining today's webinar. I'm your host, Chris Orestes, the president of Retirement Genius. It's a pleasure to have you take some time to join us today, our final brainstorm webinar of 2023. We're going to talk about strategies to avoid long-term care bankruptcy. Retirement Genius is an information and resource platform dedicated to helping people achieve a well-balanced retirement. We focus on financial, health, and long-term care, and lifestyle information and resources. It's our belief you need to bring these together to form the three legs of the stool of a well-balanced retirement so people can retire like a genius. I'd like to start by setting the stage for today's discussion with addressing the fears of retirees. And so many of the people that we're working with every day are driven by a fear of not having enough money in their retirement to maintain their lifestyle and running out of money while they're still alive. They don't want to become dependent on others and lose their ability to live independently, needing to rely on loved ones for financial, physical support, eventually reaching a point where they need long-term care and they end up on welfare, otherwise known as Medicaid, where at that point you are more than likely to end up in a nursing home. So the problem is that so few people are preparing for long-term care. They look at it as something in the future that they can avoid, delay, or oftentimes are just confused about the reality of what constitutes long-term care, how to pay for it. And that is a real problem when you consider the statistics around the senior aging population in this country today. We've been talking a long time about how seniors, baby boomers in particular, are turning 65 at a pace of 10,000 a day. That statistic's been around for actually quite some time now. You might want to start, if you're using it, updating it to point out the reality that in a year and a half, baby boomers start turning 80. The baby boom generation has moved now into they'll be moving now into their 80s and really driving for many of them towards the eventual reality of long-term care. Even though many don't think that it's ever going to happen to them, the truth is 70% of people over the age of 65 are going to need some form of long-term care. And when you look at the numbers in this country of who's getting home care, skilled nursing care, assisted living care, it's in the millions, but that's the reported numbers. There are millions more, quite frankly, tens of millions more, that are receiving care informally from their spouse, from family members, from people who are acting as caregivers, and in many cases, not even realizing that that's what they're doing. The average couple who retires today at the age of 65, over their remaining lifespan, is looking at spending upwards of $300,000 on medical costs in their remaining years in retirement. And who pays for care? Well, start with simple reality that the cost of care is expensive. It goes up every year on average about 3 to 5%. I look back at the numbers and we've been tracking them now for close to 2 decades. And these costs have continued to escalate on average at about 5% a year. Today, the national average cost to stay in an assisted living community is about $4,500. To get home care, to remain at home, about $5,000. And if you're going to be private pay in a skilled nursing environment, you're looking at upwards of twice that amount. Who pays for care? What are the funding sources? Well, for most Americans, Medicaid is what's going to pay for their long-term care needs once they become seniors. About 35% of people who are receiving long-term care, it's being paid for by Medicaid. About a quarter of people, it's Medicare, but that's only short-term rehab stay or hospice stay. Medicare does not cover long-term care services. So that leaves private pay. About 33% of people will be digging into their pockets. You're paying out of pocket for some or all of those costs. And then for a small portion of the population, those that did plan and stick to keeping their long-term care insurance policy, about 4% of care is covered by long-term care insurance. So when you get to the perception and the reality, when people are surveyed, when you survey people and ask them the question, what are they doing to prepare for long-term care? Would they buy long-term care insurance? What are they doing financially to prepare? They said if something happened to them, 62% of the population said if something happened to them, that would prompt them then to want to get something. But oftentimes, if something happens to you, it's then too late. The reality is 64% of people surveyed have done little to no planning, because 85% of people believe that they will not need long-term care in their future. They believe that it's not going to happen to them. Their kids would never put them in a nursing home. They would be dead before they would ever need care. But the reality is that 70% of people, as I pointed out, will need care. And about an equal number of those who think they never will need care think that if ultimately it did happen to them, that they would be financially prepared, they would know what to do, and it would just get handled. Something somehow would just magically take care of their needs. When you look at insurance as a mechanism to help address this situation, there's a huge difference between the amount of long-term care insurance policies that are in force in this country and the amount of life insurance or annuities that are in force in this country. You've got, for a population of over 330 million people in this country, there's 7.5 million long-term care insurance policies in force today. Now, the good news is there's 260 million life insurance policies that are in force, and there's over $2.5 trillion of in-force premium in annuities. So there are tools to work with. The trick is making sure people understand what options they have to work with, and that even if they're at the stage in their life where they need care, they have options to help them address the unique financial challenges that are brought on by aging and declining health. This is a unique experience for seniors, for people that are aging in retirement, that how you start out when you enter retirement and how you finish retirement is very different. And not a lot of people do accurate planning to go through the curve of retirement, the initial stage, the middle stage, and then ultimately what can be the most expensive part, the end stage. The cost of care and the impact on the entire family is just something people underestimate. And what kind of options are there for people to prepare for this, whether it's in the future or for their immediate needs? Well, obviously, long-term care insurance is a viable option to help pay for the costs of care. There's a variety of products that are on the market today. The most innovative long-term care insurance products ever are in the market today. But, as is the case with all insurance, you've got to be healthy, relatively at least healthy and young when you're buying it to make it work for you. And as I pointed out, too few people are actually getting to the point where they buy long-term care insurance. I would even venture to guess that those on the call today, the vast majority of people on the call today, do not own any form of long-term care insurance. So what about the people who've waited too long and now they have a need for care and they have to figure out how they're going to address it? What other options are available to help somebody avoid long-term care bankruptcy? Well, let's start by looking at long-term care annuities, one of the strategies to avoid LTC bankruptcy. This is a specific fixed indexed annuity that provides resources to cover long-term care with a long-term care rider attached. There are tax advantages to this annuity. There's income growth and protection for the income with guaranteed rates of return and an ADL-based income enhancement trigger that somebody can use if they get to the point that they need care. So in the LTC-based FIA that we work with, there's a guaranteed rate of return of 5%. And look, today's interest rate environment is very favorable for annuities. That's why we've seen so much annuity business happen over the last 2, 3, 4 years. People have started to look at annuities as a flight to safety, a way to avoid the risk of being out there in the equities market, to ride those ups and downs, to lock in a guaranteed rate of return, to lock in a guaranteed income stream, and to have the options to include things like beneficiary riders, long-term care riders. And for this particular product, this long-term care rider will allow somebody who qualifies for long-term care services to increase the principal amount of their annuity by 2 to 3 times what they put in. In simple numbers, let's say you opened up this annuity with $100,000. 3, 4, 5 years later, you need long-term care services. You trigger your long-term care rider. That $100,000 is now $200,000 or $300,000 available tax-free to spend on long-term care. And you can even make sure that this is set up so that a beneficiary could receive any unused account value. Let's talk about life settlements for a minute, a way to address an immediate need for care by using an asset somebody already owns, a life insurance policy, because that is an asset, it has value, and there are a number of innovative life settlement products that people can turn to address their unique needs. One, the term life settlement. Term life policies are the second most settled form of insurance, second only to universal life policies. This is used for primarily convertible term policies, and it will most likely address somebody who's on the younger and healthier demographic for life settlements, those that still have their conversion options in place. Now, it's possible to settle a non-convertible term life policy, but the underwriting and impairments for that individual would need to be pretty significant, with a short enough life expectancy for the economics to work within the parameters of that term life policy going forward. Policies are going to be, the policy pricing is going to be based on the longevity of the individual and also the economics of the conversion. So that's all going to be factored into what amount could be paid out in a settlement to the policy owner, as well as what's available for compensation to the agent. There is also the LTC life settlement. This is a specific life settlement that is oriented towards addressing immediate need for long-term care. The LTC life settlement is going to cover an immediate need for any form of senior living and long-term care service a person wants. So unlike, say, going on claim for a long-term care insurance policy where you have a 90-day wait period, claims to file, with the LTC life settlement, the moment your settlement is done and your funds are available, you can deploy that any amount you need to any form of care you want for as long as the funds are in place. Now, these funds that are paid towards care have the advantage of being recognized as a Medicaid qualified spend down. And remember, life insurance policies are an unqualified asset for Medicaid eligibility. So somebody who has a life insurance policy going on to Medicaid, that can be a non-qualifying asset that they have to contend with. Using it to fund an LTC life settlement for their care needs is both a Medicaid qualified spend down, which will not in any way delay their ability to go on to Medicaid in the future, but because they have either 2 ADLs or more, a chronic diagnosis, or 2 years or less of life expectancy, a terminal diagnosis, all of the funds from the LTC life settlement are tax-free and ready to be deployed for their care needs. This is keeping them private pay and delaying, if not even, we hope, preventing their need from ever having to go onto Medicaid. If they are private pay, now they can choose home care, assisted living, memory care, whatever it is that they want. If you're private pay, you're in control. If you're Medicaid, the state is in control. Then there's life settlement annuities. This is a way to combine the unique features of both annuities and life settlements with a seamless rollover of settlement funds into an annuity that is underwritten to provide a higher value to the annuitant than if they were getting a standard annuity. You're taking the underwriting information, the life expectancy information of the life settlement, and then running it into an impaired risk SPIA, increasing that payout on a monthly basis, increasing the value of the annuity uniquely for that individual who is aging and dealing with declining health. Remember, life settlements as a industry average in the market will pay out 5 to 10 times more than cash surrender value. So if somebody's looking at rolling over cash surrender value into an annuity, they've got to look at a life settlement also, because the potential is there to get much more than cash surrender value, which then can be rolled over into the life settlement annuity. And there are a variety of annuity options tied to the life settlement annuity that are going to address those unique needs of the individual, whether it's setting up a guaranteed income for life, making sure there's an ongoing income for spouses or beneficiaries, protecting their money from market volatility with guaranteed rates of return, tax-deferred growth, and possibly adding the income acceleration for long-term care needs. These are life settlement annuities that are in place and ready to be deployed easily, quickly, and available to you at any time that you would want to meet your client's needs. Then there's the cash benefit settlement, the traditional and most common form of a life settlement, the all cash lump sum payment. So the policy is sold off as an asset, just like a home. There's no restrictions on the use of the funds. If you sell your home, there's no restrictions on what you can do with that money. And if you sell off a life insurance policy, there's no restrictions with what you do with that money. There's no out-of-pocket cost for the policy owner at any time in a life settlement. And remember, a life settlement is selling off an asset. It is not a loan. So unlike, say, a reverse mortgage, there's no interest, there's no repayment requirements. You are selling off an asset. And unlike a accelerated death benefit rider or a long-term care rider, the insured doesn't have to be diagnosed as terminal or chronic to access the life settlement as an option. So somebody who is a bit younger and healthier than those that would trigger an accelerated death benefit rider or a long-term care rider, the life settlement is in essence an aftermarket way to accomplish the same goal with the asset and not have to jump through the same hoops that would be required by an insurance company. And then once you do the cash settlement, the funds can be allocated across any of the life settlement product options that are available, including the retained death benefit settlement. The last of the 5 unique life settlement products that you can be deploying is exchanging the in-force policy instead of for cash, or maybe partially in cash, maybe partially in a guaranteed reduced death benefit that will have no more premium obligations. The policy owner is named to the policy for a reduced amount of coverage. The reduced death benefit amount is guaranteed by the insurance carrier, and then the policy owner's beneficiaries are going to receive that reduced death benefit upon the death of the insured. And the policy owner can elect to take all of their settlement as a retained death benefit, a portion of their settlement as a retained death benefit, the remainder as cash, maybe also deploy it into use for long-term care through an LTC life settlement, maybe deploy some of it into an annuity, the life settlement annuity. You have a variety of options to use these products to address the unique needs of your clients. Another strategy to avoid long-term care bankruptcy is the reverse mortgage. A reverse mortgage is another way of saying a home equity conversion mortgage, a HECM, which is secured by the value of the home. This is an FHA-insured non-recourse loan on the house that the homeowner can take as a lump sum, can establish a monthly income, or which has become, quite frankly, the most popular way for people to draw money down from a reverse mortgage, establish a line of credit and just take what is needed when it's needed. there are no monthly payments for somebody who takes out a reverse mortgage. So you're able to draw down the equity in your home while you still live in the home and not be in a position where you've got to be making monthly payments. Now, to qualify for a reverse mortgage, you've got to be 62 or older. The home has to be your primary residence. You do need to be aware that there are going to be origination and servicing fees, and that interest is going to accrue on the loan for as long as the loan is outstanding. So as long as the person is living in the home, they don't need to make any payments on the amount of money that they've borrowed, but they are accruing interest. The loan is paid back when they leave their home, either by selling the home or accessing liquidity in whatever form to pay back the loan plus interest in full. Another strategy to avoid long-term care bankruptcy, which applies to veterans, is the VA aid and attendance benefit. This is a monthly long-term care benefit that's paid to veterans of active periods of war, to them and or their surviving spouse. So a veteran, as of this year, can access $2,050 a month for the VA aid and attendance benefit. A veteran with their spouse together accessing the benefit, $2,431. A surviving spouse, the veteran may be dead, but the surviving spouse would still qualify to receive, as of this year, $1,318. To qualify, you would have to have been honorably discharged from the military after serving a minimum of 90 days of active duty, with just one of those days served during an active period of war. Now, when you apply for the VA aid and attendance benefit, there will be income and asset limits. It's somewhat similar to if you were applying for Medicaid. The numbers aren't the same, but the concept is the same. If you have too much income, too much assets, it's going to be disqualifying. So to qualify, you're going to have to meet the income and asset limits. There's a minimum age of 65, and you would also need to have a disability or an active need for long-term care to qualify for and trigger the monthly benefit. Lastly, a strategy to pay for long-term care and avoid LTC bankruptcy is the senior bridge loan. This is a home equity line of credit secured against the home, which is used literally, as the name implies, for a short time to bridge the time it takes to sell a home while a person needs care. So a person who needs care could move into an assisted living community, move into some form of care while their home is still for sale. They would get a bridge loan against the home for the amount they need on a monthly basis. And then once the home sells, they would repay the loan. So you're only borrowing what you need literally on a month-to-month basis until the home can be sold, or the loan can be satisfied in another way. The payments from the bridge loan are made directly to the care provider. And for the first 60 months that any loan amount is outstanding, you're only responsible for interest payments. It's interest-only payments, while you would be waiting to satisfy the terms of the loan, either by selling the house or by whatever means you were able to liquidate and pay back that bridge loan. But it puts somebody in a position to be able to leave their home, access care, and not have to wait until the home sells to do that. You can do it immediately and then satisfy the loan through the home after the home sells. So the realities and the solutions are pretty clear. The U.S. is an aging population, and we have limited financial safety nets. There is a lot of pressure on Medicare, on Medicaid, on Social Security. The more people can understand what the real costs are of retirement and long-term care and stop underestimating what they're up against, then the better the chances are that they will enter this phase of life adequately prepared, which unfortunately a majority of Americans enter not adequately prepared. So the use of these kinds of alternative financial solutions, specifically designed for seniors who are contending with the financial challenges of aging, declining health, using specific tools provided to them through annuities, life settlements, reverse mortgages, veterans benefits, bridge loans. These have all become very mainstream in the financial ecosystem, particularly of the senior world, and continue to grow as the aging baby boomer population grows. Look, these kinds of solutions have become very well known. You know, if you are watching TV, if you're watching cable news, cable sports, cable programming, the biggest advertisers today are Medicare Advantage plans, reverse mortgages, life settlements, other than the drug companies. They are all advertising in heavy rotation. The question is, are your clients going to talk to you about these solutions, or are they going somewhere else? We want to make sure that you're informed and you are supplied with what you need to be able to address their needs, to be able to handle these, so that you put yourself in a position where you're a problem solver and not just a salesperson. Okay? What families want are people who can help them solve their problems, who can look at the landscape of solutions out there and understand what it is they could access, versus somebody who's trying to sit down and sell them a product. You know, what we want to do is make sure you have the tools to create a solution to meet their needs, versus sitting down with people and try and push them into a tool or into a product you're trying to sell. And that is the difference between the people whose practices are growing and will thrive with the aging population in this country, and those that are going to be out there just, you know, trying to sell products. So I want to thank you for joining us today. I want to thank you for being part of our brainstorm sessions. We look forward to 2024 and many more with you. I'd like to give you all a free copy of our Retirement Genius Tip Sheet, 7 Strategies to Avoid LTC Bankruptcy. Give us a call or reach out through our website, retirementgenius.com, or advisors.retirementgenius.com. And of course, you can always email me direct, chris@retirementgenius.com. I want to thank you all so very much for your time and attention today. We look forward to working with you again in the future, helping people to overcome their financial needs, particularly as they're aging and contending with the realities of declining health and long-term care.